Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 213 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to continue our talk about financial crashes and things of the like with the dot-com bubble. And for those of you who don't know what the dot-com bubble is, maybe this will be quite informative to you, and maybe you will see some things that went wrong during the dot-com bubble that reoccur in our life today and in the stock market today and in other financial markets today. And maybe this can really help you to inform the way that you invest, inform the way that you think about the stock market, and it can give you a better history of how our markets have dealt with crashes over time. Because we've talked about the Great Depression, that was a big crash. We talked about Black Monday, which was the biggest one-day crash we'd ever seen. Now we're going to talk about a crash that had a whole lot to do with excesses and a whole lot to do with things getting too exciting and too overextended all at once. And so we'll talk about that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you. And then we can go about pushing towards your long-term financial goals together. So what is the dot-com bubble? What was the dot-com bubble? Okay, well, I think before I can jump into what the dot-com bubble is, and I think you can get by .com that it has to do a lot with the internet, and we'll jump into why that is, right? But in order to understand the dot-com bubble, we need to first understand what a bubble is. Financial bubbles are the suspension of disbelief by most participants in the financial markets when the speculative price surge is occurring. It's only in retrospect, after the bubble has burst, that they are recognized, right? You don't realize a bubble until you're on the other side of it. Nevertheless, some economists have identified 5 stages of a bubble, right? A pattern to its rise and its fall that would prevent people from getting caught in its deceptive clinches, right? We don't want to get caught up in a bubble, meaning we don't want to get caught in the inflation and the floating along of asset prices higher and higher, even though those asset prices should not be moving higher and higher, okay? The 5 stages of a bubble are: 1, displacement. A displacement occurs when investors get enamored by a new paradigm, such as an innovative new technology or interest rates that are historically low. Sound familiar? Right? We've been in this type of place. Now, this is not the only characteristic or the only stage, right? But this is when a displacement occurs, right? We see these new technologies, we see these new things that come along, and interest rates are historically low, as they are today, right? And a classic example of displacement is the decline in the federal funds rate from 6.5% in July of 2000 to 1.2% in June of 2003. Over this 3-year period, the interest rate on 30-year fixed rate mortgages fell by 2.5 percentage points to the then historic low of 5.23%, sowing the seeds for the subsequent housing bubble, right? Not only did we have the dot-com bubble, but after the dot-com bubble, we had the housing bubble, right? And these were on the back of cheap money. So there were these displacements. Then once there's a displacement, then there's a boom, right? Prices rise slowly at first following a displacement, but then they gain momentum as more and more participants enter a market, setting the stage for the boom phase, right? So as money is cheaper, let's say in a housing market, right? If borrowing is cheaper, then what you can do is you can borrow money and jump into the market a lot easier. And if that is the case, if it's easy to get loans, then you can continue to push the price up, and that will create a boom in the housing market, right? And then during this phase, an asset in question attracts widespread media coverage. Fear of missing out on what could be a once-in-a-lifetime opportunity spurs more speculation, drawing an increasing number of investors and traders into the fold. I can think about multiple individual things that have been very bubble-ish, right, in the past year or so, right? Think about Tesla stock last year, right? You look at Tesla stock, it shot up many times over the course of a 12-month period, right? And it's traded sideways for some time now, right? But I mean, it's down over 30% from its highs that it hit earlier this year. So you saw that stock hit a boom based on its new technologies and the fact that money was cheap, right? And it really gained momentum, and the media covered it a whole lot. Think about Bitcoin, right? Bitcoin, the media covered it very, very heavily, and it boomed to prices that nobody ever thought it could. And again, that's something else that has kind of come back down to earth in the recent past, okay? So we see these booms, and we see this big, media coverage frenzy going on around whatever asset class we're talking about. Then after the boom, which is the second phase of the bubble, then is euphoria, right? During this phase, caution is thrown to the wind as asset prices skyrocket. Valuations reach extreme levels during this phase as new valuation measures and metrics are touted to justify the relentless rise. You will hear this all of the time. People will throw the traditional valuation metrics out the window in lieu of these newer, quote unquote, better valuation metrics. And when they do that, right, what they're doing is they're trying to justify a price going higher and higher with no logical basis as to why it does so. All right, we can just talk about a simple shift in paradigm that has happened over time, and it's stuck a little more than some of these others. But historically, a lot of people looked at the price to earnings ratio, the PE ratio, which is still very relevant today. And all that is saying, the price to earnings ratio, it's the stock price over the earnings per share of a particular company, right? And when you do that, you're saying, if I buy one share of stock, how much am I paying for $1 of that firm's earnings, right? That's what the PE is telling you. Well, as certain companies didn't have positive earnings, or they had very low earnings that led to really, really high PEs, which suggests overvaluation, what people did is they said, okay, well, let's do price to sales. So they did the stock price over the revenue per share, right? And that would give you some more reasonable basis, because these companies made money on the top line, but they weren't necessarily making money on the bottom line. And that kind of stuck a lot more, especially for companies that don't have any adequate earnings. But these types of things occur in a real common manner when we are in this euphoric stage of the market, right? For example, at the peak of the Japanese real estate bubble in 1989, prime office space in Tokyo sold for as much as $139,000 per square foot. Similarly, at the height of the internet bubble in March 2000, which we're going to talk about today, the combined value of all technology stocks in the Nasdaq was higher than the GDP of most nations, which is just outrageous, okay? So we had displacement, we had a boom, we had euphoria, now we have profit taking. Okay, profit taking is this fourth stage of a bubble. Okay, in this phase, the smart money, heeding the warning signs that the bubble is about at its bursting point, start selling positions and taking profits. But estimating the exact time when a bubble is due to collapse can be difficult because, as economist John Maynard Keynes put it, the markets can stay irrational longer than you can stay solvent. Right, so this was a big deal during the financial crisis, is that there were people, if you've ever watched the movie The Big Short, right, there were people who took short positions on some of the securities that had to fail. They had to come back down to earth. They had to become useless because they were created in such a haphazard way. Yet those individuals, those hedge funds, the individuals who made the short bets, right, they really had to wait around for a long time and make a lot of premium payments on these insurance products and maintain margin on their short positions and all these different types of things in order just to get the ultimate payoff, right? Because the markets can stay irrational longer than you can stay solvent. Even when people are profit taking, that doesn't mean that the market is going to crash. In August of 2007, for example, French bank BNP Paribas halted withdrawals from 3 investment funds with substantial exposure to U.S. subprime mortgages because it could not value their holdings. While this development initially rattled financial markets, it was brushed aside over the next couple of months as global equity markets reached new highs. In retrospect, Paribas had the right idea, and this relatively minor event was indeed a warning sign to the turbulent times to come. Okay, so that's what we have in that fourth stage in that time of profit taking. And then lastly, the last thing you have in a bubble is panic. Right? Panic selling begins to occur. It only takes a relatively minor event to prick a bubble, but once it's pricked, the bubble cannot inflate again. In the panic stage, asset prices reverse course and descend as rapidly as they ascended. Investors and speculators faced with margin calls and plunging values of their holdings now want to liquidate at any price. As supply overwhelms demand, asset prices slide sharply. Okay, so this happens in the panic time period. So we saw this in the Great Recession. We saw this in the dot-com bubble. So let's jump into what the dot-com bubble was. The dot-com bubble itself, now that you know what a bubble is, right? The dot-com bubble was a rapid rise in U.S. technology stock equity valuations fueled by investments in internet-based companies during the bull market in the late 1990s. Okay, so if you go back and look at all of these companies that were internet-based companies, their valuations skyrocketed in the late 90s because that was the hot thing. It was the hot thing to buy stocks that had .com at the end. That's right. It's called the .com bubble, right? That's why Amazon at one point was not just Amazon. It was Amazon.com because Amazon came around in that time period. Now, the value of equity markets grew exponentially during this period with the technology-dominated Nasdaq index, which we have talked about before, right? That's a lot of smaller companies. It's a larger group of companies, and they are very tech-heavy, right? The Nasdaq rose from under 1,000 on the index to more than 5,000 between 1995 and 2000. Things started to change in 2000, and the bubble burst between 2001 and 2002 with equities entering a bear market. Okay, the crash that followed saw the Nasdaq index, which rose fivefold between 1995 and 2000, tumble from $5,048.62 on March 10th, 2000 to $1,139.90 on October 4th, 2002. That is a 76.81% fall. The Nasdaq fell by over 75% in that short a time. That is crazy. It's crazy to think about that an index can fall that far in that short a time. But that came because all of these .com companies were not legitimate in the way that they were, trying to trick the market into thinking that they were legitimate, and they were getting these big investments, having these big IPOs, and getting a lot of money, and yet not being legitimate investments for people and not producing anything of value to the economy. Okay, it would take 15 years for the Nasdaq to regain its peak, which it did on April 24th of 2015. So it took from 2000 to 2015 in order for the Nasdaq to reach a new high again, which is outrageous. If that happened with the S&P 500, you would have a lot of disgruntled investors. You would have a lot of people thinking that, the market has changed forever. And in some ways, the dot-com bubble did change the market forever, right? But it was a short period of time in which the market changed, right? And the market then came back to its old ways in a lot of respects. Now, the dot-com bubble, also known as the internet bubble, grew out of a combination of the persistence of speculation or fad-based investing, right? We know what speculation is. It's anything that is not investing. It's basically gambling, right? You're putting your money into something that has no reasonable basis to go up in value, right? You don't have any reason that it should go up in value over time or that it should maintain value over time. We know that an investment, upon thorough analysis, should provide a satisfactory return and safety of principal. And these speculative assets, these speculative companies did not do so. And so out of this fad-based investing, the venture capital funds that were putting a lot of money into startups and then these dot-coms not being able to turn a profit really created a lot of turmoil, right? Created a lot of issues because if you can't turn a profit and VCs are losing their money and then pulling out of their investments, then that is going to have a real big impact on the market. Investors poured money into internet startups during the 1990s, hoping that they would one day become profitable. Many investors and venture capitalists abandoned a cautious approach for fear of not being able to cash in on the growing use of the internet. Again, does this sound familiar? Does it sound familiar that people have this fear of missing out, right? They have this fear of missing out about new technologies, and they want to invest in these things that are new technologies, and they want to invest in them at their highs, right? They want to just keep pushing the price higher and higher. And the truth of the matter is that investors don't necessarily look to push prices higher and higher and higher, even though that's what they want. Right? What investors are trying to do is they're trying to get in to the action before the action is over. And so when you think about it, all that means is that as they continue to flood in, the price is going to continue to rise. And that fear of missing out can push markets higher. Now, with capital markets throwing money at the tech sector, startups were in a race to quickly get Startups were in a race to quickly get big. Companies without any proprietary technology abandoned fiscal responsibility. They spent a fortune on marketing to establish brands that would set them apart from the competition. Some startups spent as much as 90% of their budgeting on advertising. Record amounts of capital started flowing into the Nasdaq in 1997. By 1999, 39% of all venture capital investments were going to internet companies. That year, most of the 457 IPOs, initial public offerings, where companies they go public for the first time, which we've talked about before, they were related to internet companies, followed by 91 in the first quarter of 2000 alone. The high watermark was the AOL Time Warner mega merger in January of 2000, which became the biggest merger failure in history. Okay, so this market got really hot, and people thought that they could get by with investing in companies that weren't proven to do anything, and that the fact that those companies just had .com on the back end would allow them to become profitable at some point, and that was for sure not the case. And I can't help but to think about one particular thing in financial markets today that seems the exact same way, right? Because there were companies that came out of the .com bubble and became extremely valuable and became extremely successful, right? I talked about Amazon earlier. Amazon is one of the biggest of such companies today, right? But a lot of companies didn't, right? So I think today about the cryptocurrency market, right? I think about how there's so much speculation that occurs in the cryptocurrency market. I think about how there are all of these quote unquote altcoins, right? There's all these different, tokens that you can purchase, and all these different coins that are saying that they're going to do different things, but it's all in the name of decentralized finance, and everybody still puts a lot of money into the Bitcoins and the Ethereums and things of the like, right? But how many of those coins are actually going to survive? How many of those coins are actually going to become something later on? And that's what people did not think about these .com companies. They were putting money into all of them because they were like, this is the future. They're all going to survive. They're all going to make money, right? And some people are doing that with cryptocurrency, which may come to be their demise, because just inevitably, they're not all going to survive, and the flows of money into them are not going to continue over time, right? So that's something that I just kind of draw a one-to-one connection of the .com bubble and the cryptocurrency craze, okay? Now, you kind of have an idea of what the .com bubble was, but then you have to understand it led into a recession, right? There was a recession from March 2001 to November of 2001, and that came like right on the back of 9/11, right? 9/11 was right there in the middle of that, and you don't really know a recession until you look back at it, right? But the collapse of the .com bubble had a lot to do with it, because these companies, right, they employed a lot of people, and they were supposed to be the next big thing, and they were taking up a lot of the stock market, and they were forcing asset prices higher and all these different things. And when these companies failed to exist, and when these companies failed to succeed, then asset prices came down sharply, and then so would the Fed funds rate, then so would, the unemployment rate would not go down, it would increase, right? And so it led into a mild recession over that 8-month period. So you have to understand that things that occur within financial markets can lead to broader issues and can lead a country into a recessionary period, okay? Now, what did I want to get to overall, and what have I been wanting to get to all week as far as each of these different crashes that we've talked about? I want to talk about the lessons that we can learn, right? Because it's one thing to talk about them, it's one thing to learn the history, but it's another thing to take some things away and apply them to your own life and your own portfolio, your own financial situation, okay? Now, there's 5 things that I want to talk about, but let's talk about the first. The first is diversification matters, all right? One of the most established strategies for protecting a portfolio is to diversify into different market sectors, right? Or diversify into different types of stocks, or to employ asset allocation into different types of asset classes. In other words, don't put all your eggs in one basket, right? It may be tempting to go all in for the latest hot stock, or to invest in a sector you're intrigued by or think you know something about. But if that stock or sector tanks, as tech did in 2000, you could lose big. And a lot of people put all of their money into tech. They were putting all of their money into these Nasdaq stocks. They were putting all of their money into things they thought were going to skyrocket in price over time. And again, there are people who have done this with cryptocurrency, right? So I'm just saying there's a lot of comparisons that you can do with the tech bubble and the crypto craze, all right? But what it comes down to is that diversifying your assets, it matters, right? It matters to put your assets in different baskets. You don't need to put all of your things in one place, because when that one thing collapses, then you're at a loss. Yes, I invest in individual stocks, but when I invest in individual stocks, I do so in different types of individual stocks, stocks that are in different sectors from one another, where their profits aren't all driven by the same things, right? I try to diversify the individual stocks that I own. Even though I don't own a ton of individual stocks, I don't want them to be all reliant on the same things occurring, because if one of those stocks goes to zero, I don't want my whole portfolio going to zero, right? That doesn't need to be the case. So you have to diversify. It does matter. Diversifying your portfolio won't necessarily ensure a profit or guarantee against loss, and you might not be able to brag about your big score. Over time, though, and with steady influxes of money into your account, you'll likely have the opportunity to grow your portfolio while experiencing fewer gut-wrenching bumps along the way. This is why I tell you guys all the time that investing in index funds, in low-cost index funds like the S&P 500, can be very valuable, because you naturally get diversification in the stock market, and you'll naturally not be at the whim of the market and of one individual stock crashing. And then the second thing that I think we can learn from the dot-com bubble is that ignoring investing basics can have consequences. Okay, even as the stock market began its meltdown in 2000, individual investors caught up in the rush to riches continued to dump money into equity funds, and many failed to do their homework and research the stocks that they were buying. Prices didn't always reflect the underlying business performance. Most of the new public companies weren't profitable, but investors ignored poor fundamentals and increasing warnings about overvalued prices. Right? When you get into these bubbles, like we talked about earlier, people get into this euphoric stage where they think things are going to go up forever and things are never going to come down, and there's never going to be a reason for things to come down. And of course, these companies are going to be profitable because the technology is that good, so they have to be profitable, right? Well, not necessarily, right? But if you just look at the technology, if you just look at the potential, and you don't look at what actually is, then you're going to have a lot of issues, because a lot of investors like to look at future growth. And that makes perfect sense, because the only way you can price a stock today is to know what future cash flows it will create tomorrow. But the problem with that is that there is no guarantee on those future cash flows, right? So you have to have a certain level of certainty about those future cash flows. And if there is no level of certainty or basis by which you should be assuming that they will make future cash flows, then you cannot put a value on a stock. There are many ways to analyze a stock that you're interested in, with technical, quantitative, and qualitative analysis, and by asking questions about red flags, right? It can help in determining whether a company is undervalued or overvalued, which is ultimately what we want to know. We want to invest in things that are undervalued and divest from things that are overvalued, okay? Even if you're familiar with what a company does and the products and services it offers, it can help to look deeper. If you don't have the time to do your due diligence to look at price to earnings ratios, business models, industry trends, you may want to work with a professional, or you may want to invest in index funds and not worry about individual stocks. And that will help you out a lot in not having to worry about putting valuations on things like these individual stocks that there may be no basis for them to go up over time, okay? So that's the second thing. Ignoring investing basics can have consequences. Now, the third thing that we can learn from the dot-com bubble is that momentum is tricky, right? Momentum trading, when done correctly, can be profitable in a relatively short amount of time, and successful momentum traders can turn out profits on weekly or daily basis, right? But what I teach you on this show, and what we are not momentum traders, right? We are long-term investors. We aren't about short-term gains. We are about long-term investing and long-term returns. Tech stocks rallied in the late 1990s because the internet was new and everybody wanted a piece of the next big thing. But when the reality set in that some of these dot-com darlings weren't going to make it and others would take years to turn a profit, the momentum faded, right? Investors who got in late or held on too long out of greed or panic or stubbornness came up empty-handed. Right, and this is the issue with momentum. The issue with momentum is that, yeah, on the upside, it's great, right? And if you can ride the roller coaster up, then that's awesome, right? But when the roller coaster comes back down and you're still holding on, then whose fault was that? As an investor, you're not just judged by the money that you could have made, but you are judged by the money that you actually make as you hold on to investments over a longer period of time. Now, identifying a potential bubble is tough enough, and it's only the first step in avoiding the fallout should it eventually burst. Determining when that will happen can be far more challenging. If day trading strategies and short-term investing are your thing, you may want to pay attention to the trends in your own gut and get out when they tell you it's time. But this is not what we want to do, right? We don't want to be short-term traders. We don't want to listen to our gut, right? We don't want to look at trends, right? We want to understand long-term value and how companies are going to grow over time and how markets are going to change over time and how we can make the best outsized returns over a long period of time, a 5, 10, 15, 20, 25 year time horizon, not just over the next week or month, okay? So momentum is tricky. Fourth lesson that I think we should learn from the dot-com bubble is that history may repeat itself, but it does not clone, right? Again, we may see stocks get overvalued at some point, but it's not ever again going to be because of internet stocks, right? So it's not going to be exactly like that, right? It's not necessarily going to be stocks. Like I said, it could 100% be cryptocurrency. It could 100% be some other type of financial asset. I mean, we saw another bubble just some years later in the housing market, something that people weren't looking for. Typically, right, when history repeats, quote unquote, right, it doesn't repeat in the exact same place, and it repeats somewhere where you may not be looking for it to repeat. Typically, bubbles occur where we're not expecting bubbles to occur. All right, you only see these types of things in retrospect and see what occurs in retrospect. But you have to understand that history is likely to repeat itself, and stocks are likely to get overextended at some point because people get euphoric, right? As long as there are individuals in markets, behavior is going to matter, and behavior was a big driver of the dot-com bubble and its eventual popping. Now, the last thing that I think we can learn from the dot-com bubble is you can't always predict a downturn, but you can prepare. Okay, the dot-com stock market crash hit some investors hard, so hard that many gave up on the stock market completely. Okay, that's not uncommon. Investors' decisions are often driven by emotion over logic. But the result was that those angry and fearful investors lost out on an 11-year bull market. You don't have to look at every asset bubble or market downturn as a signal to run for the hills. Also, if the market decline is followed by a rally, you could miss out. One strategy, along with diversifying your portfolio, may be to keep a small percentage of cash in your investment or savings account. That way you will have protected at least a portion of your money, and if markets fall, if markets crash, then you can take advantage of the fact that there is a little money there that's liquid that you can invest and that you're ready to put into the market. And I think that's a perfectly fine idea and a perfectly good way that you can take advantage of downturns, right? Investors should also really look at a company's fundamentals as well. Does the business make sense? Does it seem like they can grow their sales and keep costs low? Who are their competitors? Do you trust the CEO and management? After deep research into these topics, if the company is still attractive to you, then it could make sense to hang on to at least some time of the future in at least some of the shares that you purchased, right? If you're a long-term investor who's purchased shares in strong, healthy companies, those stocks could very well rebound. But this is an incredibly difficult process that even seasoned investors can get wrong when it comes to timing, right? It's perfectly fine to buy companies and hold them for the long term like we want to. And it's perfectly fine to buy things that are trendy, right? As long as they are good companies and you expect to hold them for the long term. But don't get so caught up in the trend that you hear everybody saying that it's going to change the world or that everything's different now, or those are dangerous words in the stock market. And every time you hear that it's different now, it's likely no different. Asset prices are going to come back down to earth. Things are going to revert to some proverbial mean when it comes to the stock market and its valuations, right? So don't allow any euphoria. Don't allow the fear of missing out. Don't allow the increase in prices to scare you into some stock or scare you into some asset class that you know nothing about, and then it is likely that you end up losing your shirt on that type of thing. I'll give you one quick example, and then I'll close out today. We've had the whole GameStop thing that occurred early in this year, right? Where the short sellers were squeezed out. I did a whole episode on this if you want to go back and look at that. But with this whole GameStop fiasco, right, what was occurring was a lot of people were just jumping in order to push the shorts out, but there was no reasonable basis that the stock should be increasing in the way that it did, right? But even though the stock increased in the way that it did and there was no reasonable basis, people kept jumping in because they wanted a piece of the trend. And a lot of people lost money with GameStop and AMC and those different things that they were trying to squeeze the shorts on just because they got greedy and just because they wanted a piece of the trend. That's just a small example, but when an entire sector of the market does that, like it did in technology in the early 2000s, then it can cause a big issue. And I don't want us to get caught up in trends so much that we end up making bad investment decisions. Invest for the long term. If you don't have the emotional maturity and mental capacity to be investing in individual stocks, you just don't have the time to do the research, then just invest in index funds and they will serve you well over the long term. But I think the dot-com bubble is a really good case study and something that we can look back on and go, hey, this type of thing is likely to occur again, but we need to be able to recognize it. We need to be able to stay away from speculative assets at all costs. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Tune in tomorrow as I talk about the Great Recession and one of the big crashes that all of us can remember in our lifetime. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.